All right, let's talk about decoding the secret language of the financial markets. And no, we're not going to be using a bunch of complicated indicators. Instead, we're going to learn how to read the story that price itself is telling us every single second. This story, it's called market structure. And believe me, it is the key to seeing the market like a pro. So, you ever wonder how the pros do it? How they look at what seems like just a totally random chart and see a clear story? Well, the answer is actually pretty simple. It all comes down to a few core principles of how price moves. And by the end of this, you're going to understand them too. So let's dive right in. Okay, so first things first, we have to start at the very beginning with the absolute foundation of it all. What exactly is market structure? You can think of this like learning the alphabet before you can even try to read a book. Every single analysis, every trade idea, it all starts right here. Really, when you boil it all down, market structure is just the framework of peaks and valleys. You'll hear traders call them swing highs and swing lows that price naturally creates as it moves around. By just looking at this sequence of highs and lows, we can figure out what the market is doing right now. Is it trending up? Is it trending down? Or is it just kind of going sideways? It's the market's way of literally telling us who's in control, the buyers or the sellers. And this makes the whole thing super simple to visualize. So in an uptrend, what do we see? A series of higher highs and higher lows. The staircase analogy here is just perfect, right? You take a step up, that's a new high, and then you rest on a landing, that's a higher low. A downtrend, well, it's just walking down that same staircase, creating lower lows and lower highs. This simple pattern, this is the heartbeat of any trend. Okay, now here's a really crucial idea, so listen up. Not all of these highs and lows are created equal. In a healthy uptrend, that swing low is considered strong. And why is that? Well, because for the uptrend to keep going, that low has to hold. But the swing high, that's weak. We actually expect price to break right through it. And of course, the complete opposite is true in a downtrend. Getting this difference between strong and weak points, it's an absolute game changer. All right, so now we get to learn our first word in this new language, the break of structure, or what traders just call BOS. So if market structure is the alphabet, think of BOS as the signal that tells you, hey, the story is continuing just like we thought it would. So a break of structure, or BOS, happens when price does exactly what we're expecting it to do in a trend. It breaks through one of those weak points we just talked about. So in an uptrend, it's going to break the last high. In a downtrend, it breaks the last low. It's basically the market giving you a big thumbs up saying, yep, this trend is still going strong, the momentum is still here. And you can see it perfectly right here. On the one hand, you see price breaking that weak high. That's a bullish BOS. On the other, it's breaking the weak low, a bearish BOS. Now, this isn't about predicting the future. It's about confirming what is happening right now. So just burn this into your brain. BOS confirms the trend. But trends don't last forever, right? So what happens when the story starts to change? What's that very first clue that a trend might be running out of steam? Well, that brings us to our second key signal, the change of character, or CHOCH. This is your big warning sign. A change of character is pretty much the exact opposite of a BOS. Remember those strong points we said were supposed to hold the whole trend together? Well, a COC is what happens when one of them finally breaks. So in an uptrend, if price suddenly crashes below that last strong higher low, bam, that's a COC. It's the first piece of real evidence that the balance of power between buyers and sellers might be shifting. Okay, this right here is probably the most important part of this whole explainer. Let's break it down side by side. A BOS confirms the trend. It does that by breaking a weak point. A CHOC, on the other hand, warns of a potential reversal, and it does that by breaking a strong point. One goes with the flow, the other goes against it. Seriously, if you only remember one thing from all this, make it this. BOS confirms, CHOC warns. All right, you ready to level up? Because not every break of structure you see is legit. The market is absolutely filled with traps designed to fool inexperienced traders. This next concept, well, this is how the pros filter out all that noise and avoid falling for those traps. So this trap has a name. It's called inducement, or sometimes a liquidity grab. See, the big institutional players, they know exactly where most traders are placing their stop losses. An inducement is a deliberate move they make to hit those stops, grab all that money, that liquidity, before the real move actually starts. It usually looks like the very first, most obvious little pullback after a new high or low is made. So here's what that trap looks like in the wild. Price makes a new high, and then boom, it immediately breaks it again. Looks like a perfect BOS, doesn't it? But hang on, notice how it didn't pull back first to take out that little recent low? That's a huge red flag. This is a super high risk signal because that pool of liquidity, the inducement, is still sitting right below that minor low, untouched. A pro trader sees this and immediately thinks potential fake out. And now, here's what a real confirmation looks like. Just look at the difference. First, price dips down and sweeps the liquidity from that minor low. It takes out the inducement. And then, after it's done that, it breaks the high. That is what we call a valid, high-probability break of structure. It's this one tiny detail that separates professional analysis from everyone else's. They wait for the trap to be sprung before they even think about making a move. Okay, so we've got the alphabet, and we've learned a couple of keywords. Now, it's time to start forming some actual sentences. Let's take all these concepts and put them into a practical framework that you can actually start using. Here's the thing. Pros never look at just one chart. They align multiple time frames. So, step 1, you start high. Identify the main trend on a higher time frame, maybe the daily chart. Think of this as figuring out which way the main river's flowing. Step 2, you zoom in. Go to a medium time frame like the 1-hour chart, and you wait for the structure to shift in your favor, like waiting for that CHOCH. And finally, step 3, you zoom in again to a lower time frame, say the 5-minute chart, to nail down your exact entry with a confirming BOS. This top-down approach is all about stacking the odds in your favor. So once you've got your trade idea, you basically have 2 main ways to get in. There's the risk entry. This one is fast, it's aggressive. You jump in as soon as price hits that level you identified on the higher time frame. The upside, potentially a bigger reward. The downside, lower probability. Then you have the confirmation entry. This is the patient approach. You wait for that final confirmation on the lower time frame, like that BOS, before you pull the trigger. It's slower, sure, and the reward might be a little smaller, but your probability of success is much higher. There's no right or wrong answer here. It's all about what fits your personal style. So why does any of this really matter? I mean, what's the big takeaway? It's actually really simple. Understanding market structure is your #1 risk management tool. It keeps you from swimming against the current, from fighting the market. And maybe most importantly, it protects you from making that classic, painful mistake of buying at the very top or selling at the absolute bottom. So there you have it. You now have the basic building blocks to start reading the language of price for yourself. The next time you pull up a chart, don't just see a bunch of random lines wiggling around. Instead, look for that staircase. Identify the strong and weak points. Listen for the BOS and the CHOCH. Ask yourself, what story is this chart trying to tell me? Now it's your turn to go find out.